Hello, Theo traders. This is Gianni DePoce coming to you for a market recap on the 5th of December, 2023. And I want to talk about what's going on in the equity markets in relation to the rebound that we've seen in the US dollar over the last couple of trading sessions, especially against the euro and the yen. Now, stocks have continued to hold up relatively nicely following their impressive gains. But if we go ahead and start off by looking at a chart of the dollar yen here, we can see that the dollar is starting to catch a bid on key technical support. So this is a pivotal moment in the currency market, especially since we've seen so much of the equity market strength over the last couple of months come off the back of a pullback in the dollar. Now, obviously, the yen has been much weaker than the euro over the last couple of months, but we're starting to see a shift in that regard in the sense that the yen is actually starting to display some notable strength against the euro. Now, obviously, we're just looking at the dollar against the yen here, but we are in the time band for an important cyclical low, and we're right on technical support. So this would be a logical place for the dollar to stage a rebound against the Japanese yen. Otherwise, I think we are threatening a more significant breakdown from this topping formation, this rounding top here. And if that happens, we could see a drop and even retest of the lows from July. So let me go ahead and jump over to the euro here, because the dollar continues to accelerate in its rally against the euro. In other words, the euro is accelerating its losses against the dollar. And the big question is whether we completed the right shoulder of a longer term head and shoulders formation. Now, the euro's been selling off for about 5 days in a row. There does seem to be an acceleration of downside momentum in this currency pair. And again, a lot of, the high in stocks, really or earlier this year was in July. And you can see that when we bottomed here in October, that's when stocks really started to accelerate to the upside. So that's why, I think we need to be very cautious here with respect to this equity market rally, because the intermarket dynamics are starting to shift. And, we are entering a phase of various market cycles where I would like to see a correlation, a positive correlation between stocks, between bonds, and the US dollar. I do think that we could see that, and usually that's indicative of markets being in the later stages of their particular cycle. So that's what I'm keen on right now. Obviously, the euro's been in a long-term downtrend for many years. But this year, we made the high of the year back in July. And, what we did last week on the 29th of November was potentially form another significant lower high with respect to the trend. And as the saying goes, that I did not come up with, the trend is your friend until the trend ends. So, the big level to watch, I think, if this pattern unfolds accordingly, will be this neckline of this head and shoulders formation. If we start to see the euro drop below, 105 or 104.5, then I think we'll probably see a return to par very quickly. And the question, of course, will be, how do we react in the equity market, which we can go ahead and take a look at now. I'll start off by looking at the Nasdaq, which is, slightly higher today so far, still about an hour left in the trading day here on the 5th of December. So obviously could still finish lower on the day, but I would view this price action over the last couple of days as generally constructive. As a rule, consolidation near the highs of a move tend to resolve in the direction of the underlying trend. And obviously, if we go back from the beginning of the year, the trend has been up. We see that due to the series of higher highs and higher lows. And, now what I'm looking at here is a broadening wedge formation in the Nasdaq, and we've been consolidating near resistance of this pattern. In fact, we started to break above it, but, the fact that we haven't slammed back lower after the initial breakout, I think, is a good sign and suggests that we could yet still see higher prices in the Nasdaq. Now, the Dow has been displaying some notable leadership in the last couple of sessions. You can see that the Dow just rallied to its high for the year. That would have been on the 1st of December, last Friday. And, usually when you see the Dow start to lead in such a manner, it does suggest caution. from a purely risk on, risk off standpoint, you do want to see tech and various growth sectors of the market, tech, communications, consumer discretionary, outperform to the upside. And we've generally seen that, the top 3 sectors year to date in the S&P 500 are technology, communication services, and consumer discretionary. But I'm also very intrigued with the, outperformance of many retail names in the retail sector. Names like Abercrombie and Fitch and Skechers, stocks like that, breaking out to new multi-month highs and whatnot. That does suggest that the market does have a bit of confidence in the consumer going into the holiday shopping season. Obviously with inflationary pressures coming down over the last several months and crude oil being absolutely decimated in the last few sessions. We can take a look at that real quick. Crude oil continues to fall to new multi-month lows, and this is very much a tailwind with respect to the consumer, putting more money directly back into the pockets of the consumer right around this holiday shopping season. This is where a lot of retail companies move into profitability for the year. So this is something that I think is good. But, if we go ahead and look at bonds, look at the 30-year treasury, the key here is how high and how long can this rally last? And is this rally in bonds simply the function of lower inflation, or are bond markets pricing in an economic slowdown in the next year or so? So that will be the ultimate tell, I think. But the way that markets are pricing in the likelihood of a Fed rate cut next year in 2024, it's probably a bit of both. So obviously crude oil being subdued does kind of put me in the camp that demand in the economy is slowing. So, obviously bonds are going to do better in that environment. But, stocks are holding up as pretty well too. So as long as stocks are doing well, I think it's more of an inflationary story versus an economic slowdown. If stocks start to roll over, then we have to give more weighting to the economic slowdown narrative. So I want to go ahead and take a look at some important stocks here. Obviously, we'll look at a few of the Magnificent Seven names. You have NVIDIA that has been consolidating near resistance. It's still within this rectangle formation, more or less. It's looking pretty good. But, as long as a stock like this isn't rolling over, I think it's a really good sign for the market overall. In the TheoTRADE member chat room, we have been talking about CrowdStrike for quite some time. This continues to make new highs and display some very bullish price action. It already satisfied our preliminary upside objectives. So this was a stock that we had in the portfolio, and we captured our initial gains and are now letting our profits run. So that's always a nice position for a trader to be in, reducing risk and letting the market do the rest of the work for you. One stock that we recently covered in the chat room is GitLab, and they had an earnings report recently that basically the news wasn't as bad as expected. So their loss in the earnings report was less than expected, and markets responded positively. It's up almost 11% on the day as we do this video here. But I think the big thing here, what we're seeing is the strength in tech. Even though stocks have been consolidating recently, I do like the price action that we're seeing in tech. And I think that bonds coming off the lows over the last couple of months, or last few weeks here rather, is a tailwind for the tech sector to continue to push the rest of the market higher. Because remember that tech is the largest sector in the equity market, and its movements have a disproportional impact on the direction of the indices. So as long as tech continues to rally and we see names like this break out, I mean, you even take a look at Apple having a very nice day here and is close to testing its recent highs. So this isn't the type of price action that we would normally see in a market that's about to roll over. So, as we put the pieces together, I still think it's prudent to maintain a generally bullish outlook on the equity markets. But, if the data starts to shift, we will obviously adapt accordingly. But, the fact that inflation seems to be subdued in the near term and tech is outperforming, interest rates are coming down. I also would not sleep on the real estate sector going into 2024. A lot of real estate activity has been kind of frozen over the last 12 to 18 months due to mortgage rates and interest rates spiking. But with commodity prices coming down and and interest rates coming down too, I think we could see a big surprise in real estate activity in 2024. But that's all for now that I had for this week's recap video, or today's recap video. So Gianni DePoce for TheoTRADE. We'll see you next time.